Testing, testing. All right. Hello, everybody. It is a wonderful Friday afternoon. And yeah, if you caught the last stream, I just did. It was 42 minutes of me talking about nothing because my my mic muted. So you didn't hear anything. It was just me talking to myself, which I'm doing right now anyway. But yeah, if you go watch that, I privated them. You can't hear a damn thing after the beginning, so it's my fault. All right, so we're gonna try this again. Hopefully, it's not 42 minutes this time, since I just went through it, and we're gonna do this again. Let's make sure that the I could hear myself in the headphones. Yeah, so we are good. All right, let's make sure that both streams are going. We got it. We got it. All right. So let me start off by saying, go Lions. That was a beautiful win over the Cowboys last night. And yeah, hopefully they keep that going. It's been a long, hard road being a Lions fan. So today I want to touch on this whole AI bubble conspiracy, and it's getting to be a lot of press out there. A lot of people talking about AI and how it's going to take over all of our jobs and it's going to enslave us all and destroy the world. But I think I have a less dystopian viewpoint on it. Before all that happens, though, we need to figure out, are we in an AI bubble? And if so, is it going to burst like the .com or housing issues? Because those bubbles, as we can look back on, were pretty bad. So let's get into the whole bubble thing. So I like to start off in the beginning, like what is a bubble and what are the definitions and what are the constraints for it? And I like to go to our good friends over at Investopedia. I say good friends, they don't know who I am and they don't sponsor this show and I get no monetary nothing from them. So yeah, it's just the site I like to go to. So let's figure out what a bubble is. An economic bubble is marked by rapid escalation in asset prices, often due to speculative behavior, followed by a sharp contraction. These bubbles can be difficult to identify in real time and are usually recognized only after they've burst, leading to significant economic consequences. Notable examples include the Japanese economy in the 1980s and, of course, the dot-com bubble of the late 1990s. And they need to update this to the 2008 housing crisis that crashed a few banks. So one thing that I want to take from the takeaways is this guy right here. So Hyman P. Minsky's research identifies 5 bubble phases, which we'll take a look at. First, displacement. Boom. Euphoria. Profit-taking, and finally, panic. And I'd add another one, acceptance. Explaining the progression from excitement to market collapse. So what is a bubble? A bubble is an economic cycle that is characterized by the rapid escalation of market value, particularly in the price of assets. This fast inflation is followed by a quick decrease in value, or a contraction, that is sometimes referred to as a crash or a bubble burst. So a bubble usually forms when asset prices surge due to highly optimistic market behavior. During a bubble, assets typically trade at a price or within a price range that greatly exceeds the asset's intrinsic value. The price does not align with the fundamentals of the asset. And we do like to look at the fundamentals, which, we go to the statements often to figure out where we're going to go with the stock before we actually go to the rumor mill, which is the media. So this goes on to explain the bubbles, the different phases, some historical events. The Tulip Mania one, which was an interesting read, so you should go and read that, about the 1600s, where the tulip bulb trade blew up. And people were buying tulip bulbs for astronomical prices and even like houses and fortunes, all because of a tulip bulb that they couldn't get in their country. So, of course, they do have the housing bubble here. So they got the adjustable rate mortgages and the security backed mortgage backed securities that triggered that one. And there is a nice story about NVIDIA. In Seeking Alpha, we do have a link in the description. So if you want to go there and you want to see what I'm seeing, we do get a small cutback on that. So this guy, Invest Heroes, they did a decent write-up on why they're downgrading NVIDIA, too many red flags. One thing that they are doing is they're making comparisons to Cisco, and that'll be a running theme throughout this, about the dot-com era. Cisco at the time was the biggest valued company on the market, kind of like NVIDIA is today, doing a lot of the same things that NVIDIA is doing today, only with websites and the .com. So here's a couple of the acquisitions and investments that are happening through NVIDIA that is raising the red flags or the questions. So in April 2025, according to media reports, NVIDIA bought Lepton AI for an estimated hundreds of millions of dollars. Of course, it was private sale and private company, so you can't actually see. It is a 2-year-old AI startup that leases NVIDIA GPU accelerators. NVIDIA purportedly wanted to strengthen its position in the downstream market and capture a share of it as well. So they're leasing their accelerators to this company, and they bought it. They invested in it. It's crazy. September 2025, NVIDIA signs a deal with CoreWeave. Of course, we know about CoreWeave, to buy back its unused GPU capacity for $6.3 billion. This will purportedly allow CoreWeave's fleet to remain operational during periods of fluctuating demand. They believe this wording suggests that NVIDIA could possibly mask any decline in demand for AI capacity within its business. Interestingly, NVIDIA is one of CoreWeave's largest investors. So again, investing into a company that uses their GPUs so that when demand's down, they're supplementing it and subsidizing it. So it's not as big of a bump as what it looks like, or what it actually is. Also in September 2025, NVIDIA signed a $1.5 billion agreement with Lambda, under which it will lease 18,000 of its chips for 4 years, 1.3 billion for 10,000 chips, and 200 million for 8,000 chips. So it's probably a higher tier, lower tier chip purchase. Could also be 200 million in older technology, 2-3 years ago chips, because the chips are cyclical and they increase in power, and there's a lot of technology and innovation that goes into those. So like every other year, NVIDIA comes out with bigger, better chips. But if you bought those other chips last year for $3 billion, you don't want to just get rid of them. So you want to use them for a while. So you tend to have a depreciation schedule for those. So that's probably what this is. NVIDIA had previously invested in Lambda. The stake was not disclosed, and now the latter is planning to do an IPO. This type of financing could support the company. Interestingly, Lambda, like other companies mentioned before, leases GPU capacity. And they're not the only ones that do this. A lot of the big tech companies, Microsoft, Amazon, Alphabet, and NVIDIA, of course, all do this. Microsoft gives money to OpenAI to use their chat GPT for Copilot, and it just kind of goes around. September 2025 again, NVIDIA plans to invest up to $100 billion in OpenAI. as part of a partnership to deploy at least 10 gigawatts of AI infrastructure based on NVIDIA and other GPU chips. So NVIDIA is funding OpenAI to make ChatGPT to allow NVIDIA to run on to allow ChatGPT to run on NVIDIA chips. It's circular investing here. Well, Tom says I'm muted. I don't know what that means. Because when I hear myself, I could hear. I don't know what he's talking about. Muted. You are muted. You are very vague, Tom. Yes, they do, Tom. They do seem so bad, your mic checks. Because your mic checks are dumb. Listen, if you want to be on stream, but don't just text me all the time. All right, hang on. Let me see. Financing could support like other companies. I don't know. It sounds fine to me. Financing could support like other companies. You're out of your mind, Tom. Out of your mind. Yeah, what else is new? Well, if you're going to listen, why are you teamsing me? Why didn't you put it in the chat? I don't know. It sounds fine to me. All right. I think it's working. Tom's just out of his mind. Okay. Anyway. Thank you for that, Tom. You're always good at distracting. Yeah, if anybody can't hear, definitely say something. All right. So, it's possible that the company indeed wants to strengthen its position in the downstream AI segment. Yes, it does. For example, the case of Lambda, 1.3 billion for 10,000 chips translates into a valuation of 130,000 per chip. However, the latest Blackwell GPU costs 60 to 70,000 per unit, including NVIDIA's huge margin. So this is strange. They're seemingly pumping up the company to help along further their valuation. It all comes back to them. So this is a good read. You should go find it. And that brings me to a little write-up I made here about evaluating the AI bubble versus the .com and the housing. And we did it based on the phases. So we got displacement, new paradigm, like technological breakthrough, which we have, an AI breakthrough, which shifts investor focus. We got boom, which is prices rise steadily as more participants enter. We have that. Euphoria, irrational and exuberance takes hold with greater fool theory dominating. Buyers assume they can sell higher regardless of value. Then profit-taking savvy investors sell at its peaks. And then finally, panic. Mass sell-off triggers a crash as reality sets in. So we could look at the .com bubble, and I think this exemplifies it better than housing bubble, which it says here, exemplifies a tech-driven mania around the internet's potential, and we could really parallel that with AI's potential. Displacement began with the World Wide Web's commercialization in 1989, sparking startups with .com domains by late 1990s. The boom and euphoria set in mid-low interest rates. The Fed fueled funds it at 5%, and venture capital flooding in, 100 billion plus invested annually by 2000. Investors ignored profitability, which means the companies weren't actually making money yet, but they're investing on future hopeful gains. Many firms had no revenue but traded at sky-high valuations, which is a little different than it is today. Average NASDAQ price to earnings hit 200 times, which is sky high. Media hype portrayed the internet as a new economy, fueling speculation. IPOs like Pets.com soared 100% on one day, and it was kind of a new economy. It just took many, many years to get there. Websites are still around. E-commerce is a big thing. It grew to a big economy, but at the time, there was nothing. They were funding nothing. So fueled by speculation was very much accurate back then. Overvaluation was rampant. NASDAQ composite rose 400% from 1995 to 2000, peaking at 5,048. Then by the profit-taking stage in the early 2000s, the Fed hikes to 6.5%, and drying capital exposed the dot-com's fragility. The panic phase came when it saw NASDAQ crash 78% by 2002. So 2 years, it went down 78%, wiping out $5 trillion in value, which was huge back then. 90% of the dot-coms failed. Survivors like Amazon adapted, but the bust cost a mild recession, and it did. A lot of people lost their jobs. Unlike the Great Depression and the crash of 29, I mean, people weren't exactly jumping out of buildings, but it was bad. The housing bubble, of course, in 2007, 2008 was a debt-fueled bubble centered on U.S. real estate, blending speculation with financial innovation. Displacement stemmed from post-2001 recession low rates, the Fed funds 2%, and policies promoting home ownership. Boom accelerated as adjustable rate mortgages, or ARMs, and subprime lending exploded. Subprime organizations rose from 8% in 2003 to 20% in 2006. Investors flipped houses for quick games, and yeah, there was a lot of that. I mean, there's whole television shows, Flip This House, driving prices up 80% nationally between 2000 and 2006. Euphoria reigned. Lenders relaxed standards. That was a big one. No doc loans, 0% down. You didn't have to put any money down to buy a house. And they were giving you hundreds of thousands of dollars more than what you could afford. So you go in with a $50,000 job, and they were approving you for $600,000 worth of house. And it's like, sure, you might be able to afford the monthly payments, barely, but there's a problem with that. You can afford it when it's 2% or 3% interest. Wall Street scrutinized risky mortgages into collateralized debt obligations, or CDOs, rated AAA despite high default risks. Now, if you saw The Big Short, they talked a lot about this. They're taking these mortgage-backed securities and making them AAA rated, even though most of the housing in there was not. Overvaluation showed in home prices decoupling from incomes. Median priced income ratio hit 5.1 versus historical 3.1, which is the average. Leverage amplified it. Household debt to GDP soared to 100%. The profit-taking stage triggered was rising rates. So when it went from 2.25%, even less 2%, when I got it, went up to 5.25, and ARM resets, spiking delinquencies to 10% plus. So basically, you bought your house, your $600,000 house, on a $50,000 salary. You could afford the 2.5% payments, but when it goes up to 5.25%, which, I mean, it went up to 8% at some point, you can't afford that anymore because you could barely afford the 2.5%. So now you're underwater and you can't afford your house. You're what's called house poor. Panic, of course, ensues as foreclosures hit 2.8 million. You can't sell your house because you paid way too much for it and it's not worth that anymore and you're underwater. So you can't sell it for as much as you owe. So now you foreclose. Crashing house prices or crashing housing values 30% and spiking the Great Recession. 11 trillion in lost wealth, 8.7 million jobs gone. Bailouts like TARP stabilized banks, and of course we know Lehman Brothers went out of business. But the crisis exposed regulatory failures, which are basically the subprime loans and the sky's the limit lending. Now, if we compare these, the AI stocks led by the Magnificent Seven, Alphabet, Amazon, Apple, Meta, Microsoft, nVidia, and Tesla, have driven 80% of the S&P 500 gains in 2025, with nVidia's market cap surpassing 5 trillion at one point. Of course, it's contracted down to 4.5 trillion, only 4.5 trillion. That's an astronomical amount of money. Parallels to past bubbles are striking, but differences suggest a fragile boom rather than full mania. Yet risks of a correction loom, and I would even say not risks, a certainty of a correction loom. The question is when. Nobody can predict when. So rapid appreciation and narrative hype. AImirrors.com's internet changes everything with AI transforms all industries, which is true. It is a real product. It does real things. It's phenomenal at programming something for you these days. If you tell it what you want, what programming language, it'll just do it. And for the most part, it'll work on the first try. If not, you put the error and it'll give it to you on the second try. It's amazing. It can't quite just make up programs yet, but in another couple years, that's probably where it's going. nVidia stock rose 189% year to date in 2025. And if we look at nVidia, let's look at nVidia. For the 5-year, they're up 1,300%. All the way from $13 a share in 2020. So they are doing well, and they keep going up with little dips here and there. But yeah, they're a juggernaut at the moment. The Magnificent Seven is up 70% via the Round Hill ETF, which tracks these things. Media and execs, such as OpenAI's Sam Altman, who goes over so many podcasts and interviews and news outlets to talk up OpenAI and AI in general and ChatGPT. There is some hint of cautiousness there, but for the most part, it's foot on the pedal. Let's go. That amplifies fear of missing out, or FOMO, with AI capex of 500 billion projected, fueling 1% of the U.S. GDP growth. Now, these are estimating that it takes $500 billion a year to fuel the AI industry. So that's the estimated conservative cost of how much this thing is driving it. Overvaluation and consideration, yes. Overvaluation. That is another thing that is very similar. The S&P forward PE at 23 times versus historical 15 to 18, what it usually is. Magnificent Seven average of all those companies, 32 times, with Tesla at 176 time, which actually is now not 126. It's more like 300. Yeah. 300 times price to earnings, which is just crazy. They comprise 35% of the S&P 500, up from 12% in 2015, echoing .com's NASDAQ dominance. NVIDIA's price to sales hit 30 times pre-earnings, akin to Cisco's 1999 peak. And we all know what happened to Cisco. I mean, they're still around. They still make a great product, but they are not near the company they were back then. Speculation and liquidity, low rates post 2022 enabled hyperscaler spending, 36 billion quarterly average. The circular deals that we talked about, NVIDIA's 100 billion OpenAI investment for chips, resembles housing's CDO bundling. Investor psychology, greater fool, bets on AI superintelligence despite unproven return on investment. So one thing that OpenAI hasn't quite done is performed well profitability. So they make about 12 billion is estimated, because they're private. You can't just see into their statements. You got to go by what they say and what the mathematicians look at their inflow outflows and speculate how much it is. So around 12 billion. So euphoria stage, warnings from IMF, Bank of England, and Jamie Dimon highlight stretched valuations. Stretched valuations is the term that they're giving this. $4.6 trillion valuation. Stretched. And I'll show you something here. So if we go to their statements, we'll just go annual. On 130, 60 billion, 26 billion, 26 billion, 16 billion total revenue. And if we look at their total operating income, 81 billion, 32 billion, 4 billion, 10, 4.5. So it's going up. They're a profitable company, 81 billion. But 81 billion on 4.5 trillion valuation, there's a disconnect there. I mean, that's 40 times. It's unsustainable, really. The question is, how long will it go on before it, reacts into reality, right? So right now, we're pretty much in the euphoria stage. People are still investing heavily into these Mag 7 stocks. They're inflating the valuations. They're propping up the market. So as long as people, and retail investors are one of this, but the top 10% of investors are really the ones that are spending until there's an economic downturn to where they're not going to spend anymore and they have to, hide their money or shelter. We're just going to see this continue to go up. And when you look at retail investors, what do you tell them to do? You tell them to, if it's, Dave Ramsey or the safe investors, tell you to put it in an ETF or an index fund, put in the S&P 500. A lot of these index funds have NVIDIA in it. So NVIDIA makes up 8% of whatever is going into this index fund. It's getting money. So you invest in the index fund, NVIDIA gets 8% of that, and their valuation keeps going up. You don't have to put it into NVIDIA to help this along. So it's just crazy how this works. So what are the differences? The fundamentals support, unlike the .com, which was 90% unprofitable, a lot of these .com websites didn't have an actual product or have it yet, or the housing's speculative flips, AI leaders show real growth. NVIDIA, third quarter 2025 revenue is up 94% year over year to 35 billion, and we know that they're up to 80 billion now. Microsoft Azure, Microsoft is a huge company. They make a ton of money, and they don't just do AI, but their AI revenues is 30%. Earnings growth, Magnificent Seven at 20% for 2025 versus S&P's 12%. The PEG ratio is at 1.3 to 2, which is attractive versus greater than 3 in the other bubbles. So if you go by some of the valuations, they actually make a product. They make profit on this product. It's not just vaporware. That is part of the difference than the dot-com bubble. And really, it's the main difference than the dot-com bubble. So I'll give you my prediction when we're all done with this, and I'll let you know. Lower relative valuations. Dot-com peak saw PE of greater than 70 times. Housing had infinite multiples on non-income assets. AI hyperscalers averaged 26 times 2-year forward PE, half of dot-com levels. I would say that's probably closer to 35 now. Alphabet's 17.4 times is below S&P's 21.8. So they're stating that the price to earnings is better. So if you compare it directly to dot-com, the price to earnings of the dot-com Mag 7 is better than what the dot-coms were. Demand driven, not pure speculation. Yes and no. AI infrastructure, data centers, chips addresses genuine needs, such as cloud GPUs sold out. Unlike the tulip mania's frivolous assets, which were just bulbs that you could plant, get from the ground. Backlogs exceed 500 billion, such as CoreWeave's 55 billion, but bottlenecks, power, memory, signal supply constraints, not overbuild. And if you ever try and buy an nVidia video card when it comes out, you know that you're either going to spend way too much for it, or you're going to wait way too long for it, because they never make them enough, and they can't make enough because of what the materials need that they require to actually build the things. So one big thing is AI takes a lot of power, a lot of electricity. So you got these data centers that run ChatGPT and Grok and Gemini, Claude, all the other ones that take up a lot of processing power. So it takes a lot of energy to make these things go. If you want to make like Infinity Ward today, it costs what, 135 million to make? If you spent 135 million on AI to generate that movie, even if you don't have to pay actors and all that, it would be maybe 15 minutes worth of the movie. Maybe 20. So it takes a lot more power, a lot more money to do the things with AI than it does with people at the moment, because our infrastructure cannot handle the power load that a full AI implementation would take. Then put on top of that electric cars and such from Tesla, and our infrastructure is going to go down at some point. And you could already see the price of electricity rising in your bill. So if you pay attention, which you should, you see those rates continuously go up until we fix our power grid, make it more efficient, make it easier to get the energy, some sort of, even if it's atomic energy. We need a better way if we want AI to become a full thing everywhere. No leverage overhang, post-2008 regs, limit debt-fueled speculation. AI booms rely on cash-rich firms, such as Apple's 100 billion plus reserves. So that goes back to the circular spending. Apple buys OpenAI, ChatGPT, gives them cash for that, uses ChatGPT for them to run their services. and OpenAI takes that 100 billion and gives it to AWS to do something. It just goes around and around, and these companies propping them up for how many years. So, bottom line, is it a current bubble? I think it is, and so is they. AI trading exhibits bubble-like traits, extreme concentration, hype, and valuations stretch to .com levels, positioning it in the euphoria stage. And that's accurate. They're still spending. Everybody is just still hyped up on AI. It's starting to plateau, but we're still there. A 20 to 50% correction, erasing 20 trillion in wealth, could trigger a recession. It's very, very likely that it'll trigger a recession. If spending falters per IMF estimates, however, stronger fundamentals, profitable growth, real demand differentiate from the bust like we were talking about, suggesting a soft landing burst like .com shallow recession, tech survivors thrive. So there's triggers, there's early earnings misses, there's energy constraints, delaying data centers, Fed hikes, if inflation goes up. So really, I think what this will happen, there's going to be a contraction. There has to be. It's going to continue to go up until the contraction. I mean, that could be years. It could be next year. It could be months. Who knows? Some catalyst is going to happen to where it finally reaches that tipping point and starts to come down, and people will panic and throw their money somewhere else. History teaches us that. The big question is when, and nobody can tell you that. There aren't indicators that can pinpoint when. I think this will be a gradual slowdown. So instead of instant crash of a couple months going down 70% or 50%, I think it's going to start to come down over time because there is a demand for the product, unlike the .com websites and services. So is nVidia going to still be around? Yeah. Microsoft's still around. Amazon's still around. Cisco's still around. I think nVidia is going to be still around. They're just probably not going to be the 4.5 trillion behemoth that they are now, but they still are going to make products. And what does this mean for your portfolio? Well, this is how we're hedging it. We don't have nVidia in our portfolio. We have look at Intel. That's the little stock that could right there. We have 3M. We have Johnson & Johnson, General Dynamics, AT&T. We have all the companies that you would think of if you're going to, build a house or or put in infrastructure or run the things that are necessary for the economy to keep going, or basically just living. We got mining. We got, of course, Coke. We got dividend aristocrats. We've got dividend kings. We got Rumble. Look at that's another little stock that could keep going, little guy. That's our hypergrowth. Hopefully he keeps going up. But as you can see, I mean, we're doing pretty darn good. We're up to 108,000. We're up 1,700 on the day. Got 12,000 in gains, not including all the dividends. And we are out of CDs. So maybe we'll get one of those at some point. But we've actually found some good stocks to buy. And this is how we're hedging it. Our portfolio, if you buy into the Mag 7, aren't going to go up as big, but we're definitely not going to crash as big either. And we're going to continue to get those dividends. And at some point, it's going to become thousands of dollars a month that you could live comfortably on. Even if there's a crash, you still get those dividends. So that is what we're doing. And how we're looking at this whole AI bubble. How are you looking at it? What are you buying? What do you want to do with all of your money? Let us know. Put us in the comments. That's all I have. There's a lot more on the AI bubble, really, and AI companies, which are kind of boring unless you're a techie, but it's there. And if you want to go through that, let me know. As always, thank you for watching and happy investing.